If you've ever struggled to understand how financial advice is priced, you're not alone. Most people can tell you what they're paying, but far fewer can clearly explain what the fee actually represents or why different advisors price advice differently. Today's video is an educational walkthrough of the most common financial advice pricing models using real numbers, independent industry benchmarks, and plain language. No recommendations, no advocacy, just how these models work, who typically uses them, and what they tend to emphasize. Investors often hear phrases like, planning is included, there's no cost to you, it's just a percentage. And yet, even after those explanations, confusion usually remains. That's because financial advice is never free, even when it appears that way. Costs are often bundled, embedded, or deferred. A bit like airline pricing or cell phone plans. The total cost exists whether or not it's clearly itemized. Industry research shows that most households ultimately pay for financial planning, ongoing advice, and investment implementation. The difference isn't whether those costs exist, it's how they're structured, disclosed, and experienced. One common pricing structure is commission based advice. This model is most often used by advisors affiliated with broker dealers, advisors who primarily sell insurance products, some dual registered advisors when operating under brokerage or insurance licenses. In this structure, compensation is tied to the sale of financial or insurance products. The visible advisory cost often appears low or even zero upfront. Typical characteristics include little to no upfront advisory fee, embedded product commissions that may range from 1 to 7%, ongoing internal expenses within the products themselves. For example, a $500,000 investment placed into a commissioned product may generate $20,000 or more in cumulative embedded compensation over time. This doesn't make the model inherently right or wrong. It simply means the primary incentive is connected to product distribution, and understanding that incentive structure is part of understanding the advice relationship. Another widely used pricing structure is the asset under management, or AUM fee. This model is most commonly used by advisors affiliated with registered investment advisors, or RIAs, dual licensed advisors when operating under their RIA capacity. Independent benchmarking studies consistently show a typical range of about 0.75% to 1.25%, a median fee of roughly 1% on the first $1 million. In real terms, that looks like a $1 million portfolio costing about $7,500 to $12,500 per year. $2 million, about $15,000 to $25,000 per year. These fees typically include portfolio management, ongoing advice, periodic planning updates, oversight and coordination. One defining feature of this structure is that fees continue regardless of transaction volume. For some people, that can feel counterintuitive, especially in years when little changes. Structurally, though, this model emphasizes ongoing judgment and decision support rather than activity. Flat or retainer based fees charge a fixed annual amount, usually tied to the complexity of the financial situation rather than asset size. This model is most commonly used by advisors operating under a registered investment advisor, or RIA, planning focused advisors offering advice separate from investment management. Industry research suggests typical ranges of $3,000 to $10,000 per year. These arrangements are often used when assets are modest, planning complexity is high, investments are not the central focus of the engagement. One trade off is that fees may not scale with asset size or fiduciary responsibility, which can matter as financial situations grow more complex. Some advisors charge hourly or project based fees. These models are often used by RIAs offering limited scope planning, advisors providing one time or episodic advice. Specialists focus on specific decisions rather than ongoing relationships. Hourly rates commonly range from $200 to $500 per hour. Project based fees may range from $1,000 to $7,500 depending on scope. These arrangements can work well for clearly defined needs, but they typically do not include ongoing monitoring or coordination unless specifically agreed upon. Hybrid pricing models combine elements of multiple fee structures. This approach is commonly used by planning oriented RIAs, dual licensed advisors offering both advisory and brokerage services. Examples include an upfront planning fee combined with a reduced AUM percentage, an annual planning retainer alongside investment oversight, planning only engagements followed by separate implementation. In practice, most households still pay for planning, advice, and implementation, whether those costs are bundled together or itemized separately. The structure mainly determines how the costs are presented and when they're incurred. At this point, many people ask which option is the cheapest. That's a reasonable question. It's just not always the most informative one. Academic research consistently suggests that long term outcomes are influenced less by security selection and more by asset allocation, tax efficiency, asset location, behavioral discipline, coordinated decision making. These factors tend to matter quietly over time rather than dramatically in any single year. Pricing models that emphasize distribution can make these elements harder to see, but they still can be present. Models that emphasize ongoing advice tend to make them more explicit. Transparency doesn't require complexity. Clarity usually matters more than detail. Instead of asking, "Is this expensive?" it may be more useful to ask, "What decisions does this advice support? How frequently is judgment required? How are conflicts disclosed and managed? What happens if no changes are recommended? How are taxes, investments, and cash flow coordinated?" Those answers often matter more than the fee itself. Understanding how financial advice is priced and who typically uses each structure allows investors to evaluate advisor relationships based on clarity, alignment, and decision support rather than cost alone. The goal isn't to find the cheapest structure, it's to understand what you're paying for and why.